All right, welcome to the Note Investor Podcast. I'm Dan Deppin, and today I'm joined by Sohail from Provident Loan Servicing. How's it going?
Doing good. We're staying busy.
Yeah, same here, same here. I really appreciate you joining. It's funny because we started talking right before we were recording, and I'm like, oh, well, this is good conversation for what we're about to do. But for the people who don't know you or don't know Provident, maybe give us a little background on you and how you got into this business.
Sure. So I've been in the mortgage business for 27 years, almost 28 years now. I've been on the front end of the transactions where we built origination platforms for large lenders, trained loan originators, underwriting, you name it. I've done all of that. Then on the back end of the transaction, I've managed large short sale operations, foreclosure operations, default servicing, you name it. I've done all of that. Um, Always wanted to be in the servicing business and didn't really, for 15 years, I had been wanting to get into the industry, but didn't really notice that there was a niche in owner financing that existed. And it was not just a
Mhm.
niche, but it's a huge need because that industry entirely is just totally fragmented. And I always thought about servicing for Fannie and Freddie and the government loans, and the barrier to entry was so tremendous that just couldn't, you know, make that entry.
Mhm.
And a little over 4 years ago, I was on a plane heading back from a vacation, and I just happened to sit next to an attorney who is one of the best in creative finance. And so, in those 2.5 hours of discussions, the light bulb goes on, and here I am. And so we've been servicing ever since. Got my license right away after that, and we started Provident Loan Servicing. Initially, it was a different company name, but now this is a different company that I started about 18 months ago.
Nice. And I'll preface this, but like, I gotta ask, like, why loan servicing? Because when I look at it, like, from my perspective, there's a lot of regulations to follow. It feels like there's a lot of friction and things you need to do on every account. Like, so for me, like, I'm definitely, an entrepreneur. Like, I've done different things, but, and I've had a lot of people suggest that I look at doing loan servicing, and I've always gagged and I've been like, oh, no, that doesn't, that's never been appealing to me at all. So I'm interested in knowing, like how you got into that or what drew you into it.
For me, note servicing was a natural transition on a from a slightly larger perspective, right? I don't want to be a small note servicer. That was never the goal. The goal has always been to be a large nationwide servicer where we're servicing owner finance notes for every, and not just owner finance notes, private lender notes. So institutional
Mhm.
lenders that may have a need, or large, REITs or insurance companies, things like that. So pretty much servicing the entire gamut of the private lending industry. And the one thing I didn't realize is it is a very labor intensive business. Your
I
your
believe it.
standard
Yeah.
GSE loans are not as labor intensive as these would be. So I call loan servicing your nickels and dimes business. You can't make it with just a few loans. It has to be a very large operation to have some sort of a from an private equity perspective, right? If I want my company to someday be acquired by a private equity firm or I have an IPO, it has to be a very large operation in order to do that. So that
Hmm.
that is my end goal. 10, 15 years from now, that's where I see my company going. But it's a lot of work. You have to deal with variety of lenders who may or may not understand the business and
Hmm.
then help them learn and help them progress if that's what they're looking to do with their note originations or acquisitions of notes and things like that.
Yeah, I mean, like what kind of things do, say, like the newer folks who maybe like they're buying their first note or notes, or they're getting started, like what things do they tend to not understand or not know going into getting set up with a servicer?
Some of the things that they don't know or truly understand is that uh, the one thing that always happens, and I have to help them understand that they need to, they should refrain from doing this, is if their borrower is late, they will themselves text and call the borrowers just at all odd hours of the day and on the weekends.
Yeah.
And that's a conversation that I have to have with them saying, don't do it because you will end up in a regulatory complaint from either the CFPB or the state where your borrower is going to go to them and say, this guy is harassing me, and all of a sudden you have a lawsuit on your hands or
Mhm.
just an inquiry that you have to answer to. That, along with some of the, I think what I experience more is with note originations where the notes are not created properly. They're incorrectly done many times. And we've had a couple of scenarios where we had to go back and tell the lender that we could not service this note unless it was
Mhm.
re. And so that has been one of our biggest challenges where they're not closed properly and we have to go back and educate them on doing this the right way. The My experience also has been with title companies where even though they know how to create owner finance notes, they're only as good as the instructions we give them. So if you give them a set of incorrect instructions, more than likely they will not give you advice on how to create the note properly. They will just follow the instructions you give them. Creating a homestead note with a 3-year balloon and a 2-year prepayment penalty, interest only, those are things that you should not do, but they do it
It's,
anyway.
I just got out, like right before we got on, I just got off the phone with someone who was creating a loan. And I go, oh, is there anything you want to change? And he goes, oh yeah, one thing I want to add a prepayment penalty. And I was like, oh yeah, I don't know about that. You don't want to.
Well, prepayment penalty by itself is okay in the sense
Mhm.
that it's frowned upon by the regulators. But if the note becomes non-QM at that point, even if everything
Yeah.
else is just in compliance. But the challenge then is, to try to sort of talk them off out of doing a prepayment penalty to begin with. And now if it's already done, then there's nothing we can do. The lender is confirming that the note is enforceable, and for me, that's good enough. I'm not going to sit there policing what they do.
Yeah. And I think like a lot of these things, refer to, owner occupied deals. Maybe you could tell us a little bit about like some of the differences when you're doing that creation of what's okay if it's going to be owner occupied versus an investor loan. Maybe somebody's going to have it just as a rental property. They're not going to live in
Mhm.
it.
So, with an investment property loan, it's very simple. I call it the Wild West. Dodd-Frank really doesn't apply to it, so you can pretty much create a note where it has a balloon provision with prepayment penalty, with interest only, and you'll still be okay. But you
Mm-hmm.
can't, when you create an owner-occupied homestead note, having any of these provisions is really frowned upon. Having all three at the same time is just the worst thing you can do to yourself.
Yeah.
And so prepayment penalties make the loan non-QM. Having a balloon provision makes the note non-QM. Not to mention the fact that if you have it less than 5 years, then it just becomes a challenge if ever contested.
Mm-hmm.
And you just don't want the note to be contested in court because you will lose.
Now, what's
So
the difference, or what's the impact if you create a loan that's non-QM versus QM?
if the note is just non-QM, you're still going to be okay as long as it's reasonable. And when I say reasonable, let's say it's a 30-year fully amortized note with a 5-year, balloon provision in 5 years. So the
Mm-hmm.
note is non-QM at that point. If it ends up in front of a judge, you will more than likely have a judge who is sympathetic to you because you gave your borrowers 5 years to possibly either come up with the money to pay off the note or refinance out. Now, if
Mm-hmm.
you created a prepayment penalty within it, then that's an issue. That becomes a
Right.
challenge. But same thing with adjustable rate mortgages. If you created a note with a 5-year adjustable rate, and then after that, if it adjusts annually, that's fine. It still becomes non-QM, but it's fine. Um, some of the other things that could potentially be non-QM is when you are as a small creditor, you have some latitude with the interest rate. Your
Mm-hmm.
interest rate can be higher than market. Your large creditors are limited to the average prime offering rate plus 3%. You, as a small creditor, can go about 6.5%. Uh,
Mm-hmm.
in, so now, if you and your note will still be a QM note, but if you exceed that, then it just becomes a high cost note. You could be treated as a predatory lender, and that just does not look good in front of a judge.
Right. And yeah, and I think one of the challenges with these things too, right, is they're not necessarily black and white lines that you cross, right? You're kind of, if you end up foreclosure and if they fight and it comes in front of a judge, then like these are all factors that will like help or hurt you. But yeah, sometimes people look for like the bright line of like, if I go here with the balloon, am I totally fine? And then if I go over here, am I having a big problem? And often it's like I find it's like shades of gray. You know, you're
Uh,
taking like calculated risks almost
exactly,
if you want to add
I've
those
heard,
features.
yeah, there's a variety of people out there that say, look, you know, having certain provisions which make the non-QM are fine because what are your chances of getting sued or having the note contested? I get that, but the way I suggest doing this is just make it as easy for your borrowers. You're still going to make money. Just do a 30-year fully amortized note with a fixed rate note within it, and you'll be fine. Even if if it gets contested, at the end of the day, you're okay.
Mm-hmm.
And then obviously you have to also watch out for the your borrower's ability to repay. And if you didn't use an RMLO and you didn't validate that your borrower had the ability to repay, then also that could become a challenge, especially to a judge. That's like you're setting your borrower up to fail.
Yeah, I'll ask kind of a facetious question because this is one that I've heard. So this isn't me asking it, but what if my borrower has a big down payment, and even if they don't pay, I'm okay because I got enough of a big down payment up front, so I'll just foreclose and get made whole that way.
We that's a good question. If your borrower does not have the ability, or they have the ability to pay, but they're very close on what are called debt to income ratios, and they do end up in a foreclosure situation with you, that will hurt your chances of winning the case in front of a judge. And so no matter what, no matter how big the down payment is, if it's a homestead borrower, it only makes sense. It's only prudent to make sure that they can pay you back. And
Yeah. Yeah, and what I tell people as well too is like even if you have, the ability to foreclose and whatnot, it's enforceable. That's not always a picnic. The borrower can fight them and drag them out. I had one just last week or week before, where the borrower filed bankruptcy on the day of the auction, and so they can get drawn out. And I think sometimes when people are a little newer to it, they may equate that similar to almost like an eviction, or they have this idea the borrower misses a payment and they're just going to get the property back. And that's not always the case. And if you do enough, you're going to have some that drag out way beyond what you would ever expect. Even if it's a more lender friendly state, it can still happen.
yeah, Texas, for example, is one of the most lender friendly states that I know of. And even here, the one thing that we're seeing more frequently now is borrowers filing for bankruptcy a couple of days before foreclosure sale. Like it happens
Mm-hmm.
like clockwork every single time now. And then, they dragged us out where you were 120 days to foreclosure. Now it's been dragged out to double that time frame. You added another 4 or 5 months to it. And so it's just never a good thing to have that happen.
Yeah, the other thing that's not fun is all the legal expenses that come with that too, because you got to file the proof of claim and then
Hmm.
all kinds of other things when they don't pay, perform on the plan. And yeah, it's way more expensive and time consuming than.
And my, I always encourage lenders to see if they can do a workout with the borrowers because in majority of the cases, there's a genuine situation, which is why they've fallen behind.
Mhm.
And in majority of the cases, when a workout is done with the borrower, they tend to perform better after that. And so it's very helpful for both parties to just come to an agreement and keep things moving forward.
Yeah, for sure. Yeah, especially for like people like me, if you're investing out of state, having an REO is just a big pain.
Yeah,
Unless it's an area you're in or you've got a team set up there, it's kind of a time, it can be kind of a time sink depending on how
exactly.
it goes. So maybe go back to like the servicing a little bit. So like what's the process? Like if somebody's new, let's say like I buy a loan or I create a loan on seller finance, like what do I have to do to get set up with a
So
servicer?
the process is very simple. We have our forms listed on the website on providentloanservicing.com. And depending on the type of loan we have two sets of documents. One is your standard loan servicing setup document. The other one is your loan servicing setup document with underlying lien. So if it's a wrap loan, then it's a different process. Just fill out the forms. They're all fillable. You can execute. You can sign online as well and send them over along with with a copy of the note, the deed of trust or mortgage, and any insurance and tax information that you may have. If you have the closing disclosure, that's even better. That helps too. And
Hmm.
literally within 2 business days, we're up and running. And what we'll do at that point is first we'll make contact with the borrower, send them a welcome letter and a phone call, and then we'll do the same thing with you as the lender and from that point the loan has been onboarded and it's ready to be serviced.
Gotcha. Gotcha. And then we were talking about this a little bit before we started, but then like, how does that work if I'm transferring a loan from somewhere else? Because me personally, this is something I've had a lot of issues with over the years. Because a lot of times if I buy a new loan and it's at a loan servicer that I haven't used before, and it's like one loan, I'll move it to one of the
Mhm.
ones that I'm using. And sometimes I've had it go very smoothly and other times not so much. So like how is that process supposed to work, I guess?
So the process in my mind is very simple. And a lot of investors think that or lenders think that it's a very difficult process. It actually isn't. There's a form that we will ask you to fill out. It's a very short form, essentially giving instructions to your existing servicer what all is needed to transfer the loan over to Provident. Um,
Mhm.
Typically, what we ask you to do is send that form over to the existing servicer and copy us on that email. Once we see the email come through, we will file it in the sense with a reminder to follow up with the existing servicer 2 business days from the original email sent date. In
Mhm.
this process, what we do is we will reach out to them to help coordinate the transfer of the loans. If it's just one loan, then it's much easier because they'll just send us the PDF documents and we'll do the data entry of the loans. Many times what we've had to do is if it's more than 10 or 12 loans or 20 loans, then what we'll ask them to do is send us a CSV file so we can do a data import into our system versus manually entering the data points. Um, in my opinion, their involvement is minimal. The work is very simple and it gets up and running very quickly on our end. So we try to make it as simple as possible and make sure that you're in the loop as well. You know what's going on and help out where, when things might be missing or if there are documents that we're still needing from them.
No, that's very cool. Yeah, because I've had more than a few, not with Provident, where you kick off this transfer and then you're like, hey, wait a minute, a bunch of time went by. What happened? And you ping them and they do like one thing and then they go dark again. And I feel like I'm like almost doing it for them as we
Yeah,
go
no,
through.
we're always communicating with them, and we do try to set sort of an expectation with a timeline,
Mm-hmm.
and then we give them certain deadlines as well. It's we don't call it deadlines, but we set those expectations where they know that if they don't respond in that time frame, then there's going to be a follow-up from us, and it just makes sense to just get all the paperwork going, not delay the process.
Yeah, that probably makes it a lot easier.
Yeah.
So,
And remember, with the RESPA goodbye letter, i- there's that 2 week to 4 week timeline that's created anyway. So it gives them ample time to get that letter out and then finalize all their offboarding processes and then send the files over or the data file over. And so there's plenty of time that's given to them legally.
mhm.
And if they still fall behind from that, then that to me is a huge issue. And I personally will jump on a call and have a conversation with their executives to see what's going on.
Yeah, and then the other thing I hear from people sometimes is, oh, well, I'll just collect the payments on this one myself. Like, what are the pros and cons of self-servicing a loan versus hiring a loan servicer to do it?
Well, self-servicing is not a bad idea if all you're ever going to do is one loan.
Hmm.
But with the amount of compliance and regulatory issues involved in servicing loans, I my opinion is it only makes sense to use a professional servicer that is well versed in all the state regulations, the federal regulations, and at the same time make sure that one of the I earlier when we were discussing this, we had this lender where he was just very he was quite stubborn when it came to servicing loans. He wanted to do this himself,
Hmm.
and the only way he learned a better way was when he was sued for an incorrect payoff that he had generated. And we stepped in, we helped him clean that up, make sure that the incorrect payoff was generated by building back the history, and then which was perfectly acceptable to both the attorney and the lender. And so at that point, it becomes challenging. Number one, if you don't have the bandwidth, if you're busy running your business, then it will be very hard to self-service these loans. And then if there's some sort of a default, following up, making sure that you're still within compliance of the Federal Debt Collection Practices Act, and at the same time making sure that the steps that need to be taken to cure the default are taken in the right timelines and the right manner. Those are just some of the hard things that are difficult for your standard typical lenders to remember.
Yeah, for sure. Oh, there was one other thing I was going to ask you about. Now I spaced out what it was. Oh, yeah. So the other thing that I've had as a lender when I've taken things into foreclosure is one of the things borrowers will often claim is that, oh, I sent the payments in, the servicer lost it. I've had at least five or six um,
Yes.
who have done that. And there was one where one time I had to actually physically go to Jackson, Mississippi, go to court, and the borrower was disputing things, and I had to go through like the loan servicer statement with the judge. I
Mhm.
managed to explain it to him, which was just good because earlier in my note career I would not have been able to do that. Um, but I always felt like, since that happens so often, I feel like I have a much stronger case when I say, well, no, this is my pay history from my licensed loan service, or this
Mhm.
this licensed loan servicer does all kinds of loans. If they were just losing payments, they wouldn't really be in business. But if it's just Dan and I've got like a bunch of receipts from a shoebox under my bed, that may go differently in
Yeah.
in in front of the judge when they make those claims.
Yeah, with us, everything is very well documented. You will have access to a conversation log where every phone call that we make to the borrower is, or if the borrower calls in, that's logged in. All the funds that come in. One of the things we don't do is if it's a partial payment, we can't apply it. We can't apply it as a payment unless we have the full payment. So that payment gets placed in reserve or a suspense account until a full payment is received, and then we apply it. Um, all of that is documented and provided to you by way of an online portal. You can see their full payments. You can see how many escrow uh, accounts or your insurance and taxes, when they were paid, which entities were paid, how much money is in a reserve account or a suspense account. So anything your borrower disputes, you have full access and visibility to those things, and you can say, nope, this is not true, this is not incorrect. Here's all the paperwork, and here are the timelines and the dates when you made certain payments, and here's how they were applied. So it
Yeah.
just makes your life easy if there's ever if there's a case that's contested, you can actually fight your case very strongly.
Yeah, because from my perspective, it seems like as much as I like to get annoyed with servicers for various things, they do a lot that I would not be able to do on my own or wouldn't want to do on my own for 35 bucks a month or whatever it happens to be,
Exactly.
you know, with them.
And
So
and in many of the cases, in majority of the new originations, the cost is passed on to the borrower anyway.
yeah, that's a good call out. Yeah, so that's yeah, maybe you can talk to that a little bit, like when you're setting up a loan. Yeah.
So on new originations, once when you're using your RMLO, or if you're doing a loan origination yourself, whatever the case may be, if you properly disclose to your borrower what the servicing fee will be, then we can pass that cost to your borrower, and there are no restrictions on whether they can be charged that fee or not. So the servicing fee really comes out of their monthly payment, and it's not part of your payout. It's separate from your payout entirely.
Yeah, and I've never seen a borrower push back on that.
No, they
You know,
always pay.
I find it best practice just to include that, and just like the the origination costs and the cost for the RMLO as well, you can pass that on to the borrower
Exactly.
when you close. And so you maybe can pivot to your, because you're also a Texas RMLO in addition to a servicer. Like what are some other things people should know when they're originating their first note, or what are things that people commonly misunderstand or instinctively like want to do the wrong way?
So a couple of the biggest things that I've noticed are they when they have a borrower, the lender really should vet the borrower to see if they have the ability to pay. It will prevent them from a potential foreclosure or even a first payment default. One of the things that I've noticed with a lot of lenders is that they will do the loan origination, they will do the note with less than 10% down or 15% down. When that happens, if the down payment is less than 10%, your chances of having an early payment default, and when I say early payment default, it literally in the first 12 months, they will skyrocket. They're closer to 90%.
Mhm.
And we see it day in and day out, where sometimes the lenders will accept less than 10% down payment. They will not collect the proper taxes or escrows, and then it becomes a bigger challenge for us, because the borrower not only doesn't have enough skin in the game, but when it comes time for us to pay taxes or pay the insurance renewals, we don't have sufficient funds to address those issues. So, number one, make sure that the borrower is properly qualified. Using RMLO, it just becomes easier because they will help you validate everything. They'll even, like our RMLO here in Texas, we will walk the lender through the entire process of creating a high quality note, which, if they ever want to sell, it becomes very marketable because it was done the right way.
Mhm.
And the disclosures are important, making sure that the borrowers are aware, have been provided with the disclosures. The timelines are important from the time you originate the loan to the time you could close the loan. Those timelines are very important. You can't cut corners in those things. And if there are changes to the terms of the note, those need to be documented as well.
Right. Cool. Well, thanks so much for sharing all that. That's probably a good stopping point. So how can people find you
Well,
afterwards?
so the best way to reach us is through providentloanservicing.com. And we service nationwide except for New York, Hawaii, and Pennsylvania. And then if you need RMLO services here in Texas, it's Centro Funding, CENTRO funding.com. They're both under the same umbrella, just different lines of business that we have.
No, very cool. And I'll put those links in the notes below. So, but thanks
Sure.
again. Really appreciate it.
Thank you, Dan.